Hello and welcome back to the Collin Cadmus Podcast. Today I'm joined by Kyle Norton. Kyle graduated from Queen's University in 2008 and then started his career in sales, where he quickly rose into President's Club and earned his way through multiple sales leadership positions, including at Shopify, before landing his most recent and current position, where he serves today as the CRO at owner.com. Kyle was also the co-owner of a mixed martial arts academy called OpenMat, and he's the host of the Revenue Leadership Podcast, which I've linked below in the show notes. Owner.com has experienced exponential growth the past 3 years under Kyle's leadership, and they sell to restaurants, which is how I started my sales career. So I'm particularly excited to get his thoughts on all that's changing in B2B sales and find out what's working and what isn't working for his team in 2025. Before we get started, if you're watching on YouTube, please take a moment to subscribe to the channel, like the video, and leave us a comment if you have questions or feedback. If you're joining us from Spotify or Apple Podcasts, please drop us a review and let us know what you think of the episode. This is much appreciated, as it really helps to grow the audience. Without further ado, let's dive in and get his thoughts. Kyle, thanks for joining me and welcome to the show.
Yeah, thanks for having me. Looking forward to it.
Likewise, man. As I was just saying before we got started, I've seen you literally everywhere. It was only a matter of time before I was able to get in touch with you. So I'm glad to finally have you on here. And yeah, I mean, you're selling to restaurants. So whenever I see someone selling to restaurants, I immediately feel like there's an element of kindred spirits here because it's a very unique game. And you can always tell when you get into a conversation with a salesperson who has figured out how to get a restaurant owner on the phone or in a demo. It's unique. We're cut from a different cloth. And you guys are just restaurants, right? There's no other vertical that you're selling to. So you're very isolated on that.
Just restaurants, just the US, just takeout and delivery heavy restaurants.
Got it. Okay. All right. Well, I'm excited to find out how you guys are getting into conversations with restaurant owners, because I'm curious actually how much it's changed. I mean, a little bit of background, when I started at Single Platform, we were cold calling restaurants. There was no email in our game whatsoever, because it was hard enough to get them to go on the computer to look at an example of what we could do, let alone get them, to answer an email or something. So back then, this was circa like 2012, right? We were just pounding the phone. So curious to find all that sort of stuff out. But let's start at the top here.
That hasn't changed much.
Okay. I had a feeling it hasn't. I mean,
not a big email culture.
Except for maybe when you're dealing with like large restaurant groups or something, right? And you've got some management type people that you can reach out to. But yeah, I mean, a traditional restaurant owner, we were trying to get them on the phone while they were in the kitchen. They're stirring the sauce and, they're juggling 15 different things. And yeah, it was always very interesting trying to get them in. And I joked on the last episode that we used to have to use a Join Me screen share to get them, just so that but we'd be on the phone, but we wanted to show them something. And so we would want to share a PowerPoint presentation. And the only way to do that was through Join Me. And even just getting to that point was so difficult because they wouldn't know how to start their computer. They'd be like, I don't know, my internet's not working. And it was just a nightmare. We'd get them to the screen share site and they'd be like, so I don't get it. Why do we want to buy a screen share site? Like they would think that's what we're selling. It was crazy, man. It was just just to even get to the point where we were actually talking turkey was really challenging. So anyhow, let's start from the top. And I've sort of changed the way I've asked this question a bunch of ways. But, I was originally asking people like, what's broken with B2B outbound and how did we get here? But some people don't think it's broken. I don't necessarily think it's broken. I think it's semantics. I think, it's interesting to hear how people answer the question. But I've rephrased it and I'm asking, is traditional outbound sales broken, dead, or dying? If yes, how so? And the idea here is to sort of chime in to, the grand debates of like email's dead, cold call's dead, all that sort of stuff. What's your take on that sort of throughout the industry and then, applicable to owner.com?
So in general, I try to avoid binary statements. It's dead, it's alive, it's good, it's bad. There's nuance to everything and everything is a spectrum. I think what people are commenting on is declining reply rates, declining delivery rates, declining effectiveness of the email channel. But that is not because there is an inherent problem with that channel. It's because there's so much more noise in the market. Every year, there's more and more startups. Every year, there's more and more salespeople. And we're trying to go after the same set of individuals. And so really what that means for me is the bar is higher. The bar to stand out, the bar to be noticed, the bar to get a reply is much higher. And so where people find challenge today is they're taking the same approaches that they were taking in 2016, where you could just load in a list of accounts, blast out lightly personalized messaging. Hey, Collin, noticed that you worked at Single Platform and you went to XYZ University. Like, vomit about my solution. Yeah, that's not really going to work all that well today. But now we've got a whole host of other solutions that can do personalization at really interesting scale. And so you have to step up your game. So I don't think anything's broken. Email's not broken. The phone is better than ever, in my opinion, because people have stopped using it as a channel. Social selling was in vogue, and now people are sour, or people just like think aren't excited about it. It's not novel, but it's as effective as it's ever been. You just have to do a lot of these things better, in my opinion.
I think you nailed it. And like going through, I think this is like 31 interviews where I've asked this question now so far. And so it's come full circle for me, because I was, originally in the camp of just like things are starting to break, everything's dying, all the connect rates are declining. And it's like, as you really think through it, you perfectly encapsulated where my thoughts have evolved to, which is that it's the abundance of noise, it's the amount of volume of what people are receiving. And there's reactions to that, right? So iPhone, you can silence unknown callers. Gmail has all these new spam filters. Like, these things didn't exist, a few years ago. And so those reactions alone, plus all of the noise, just makes it harder. So completely agree with you. Agree with you also on the phone is doing great for those who are willing to pick it up, right? If your ICP can answer the phone and you're not like prioritizing making calls all day, I think you're missing out. And social selling as well. I think I'm excited to catch up with Kevin Dorsey. I haven't chatted with him since he started his new role, but I just saw him say somewhere that he doesn't have his SDRs doing any email whatsoever. They're strictly just pounding the phones, and they're automating the email. So I want to chat about what's working for you guys today for Outbound. You mentioned you're not doing email. Are you not having your sales team do email? Are you automating some email? Are you doing anything there? Or are you just strictly pounding phones?
We do email that is more or less fully automated.
Is it coming from like specific people, or is it okay? Yeah. So it's not a marketing email.
No, it's not a marketing email. We're actually doing a project right now with Jordan Crawford to essentially to do cold email at scale. But even that is going to come from the inboxes of the sales rep. And I think this goes back to the point where people feel like things are more challenged than ever, but the pace of change is probably faster than ever. You don't get, when Salesloft and Outreach burst onto the scene, that was a durable advantage for like 5 years, basically, before it got saturated away in the ZERP years.
Yeah.
And now, email deliverability is getting tougher. The email platforms are making it tougher to hit the inbox. Okay, well then figure it out. You can use Instantly and Smart Lead and domain warming tools, and then you're going to send them out from a bunch of alternative domains. There's just a game you have to play, and you have to continue to innovate. And so one of the things, email is very ineffective. It wouldn't be a good use of a BDR's time for us. Selling into restaurants, to have them like doing much personalization by hand almost at all. We'll do a little bit here and there, especially for bigger customers and certain situations, but more or less you add a bunch of, we centrally add things to Cadence for the BDRs. Then the first step in the Cadence is an auto sent email. So the BDR doesn't even do the review and send. It just sends out on their behalf, and then they're making calls. I want to get to a place where even those emails are abstracted from the view of the BDR team, so that they're just going out en masse in the background. We're warming up accounts before we call in, and because we can do it at scale with hyper personalization it'll be through basically like a monster clay table, and we set up an MCP server that connects to our Snowflake, so we can query like the entire database and figure out like interesting insights to deliver for customers. So we'll send them really interesting campaigns and emails that teach them something about their business they probably didn't already. I can guarantee don't know. And then the BDRs will call in with specific call prompts that are tied to those emails. So like it'll be a problems-based hypothesis of need. Hey, Collin, I was just on your website and I noticed. And then they'll have a bunch of things that they can do. And the point is to do all of this at scale in the background and serve it on a platter for the BDR team and the sales team more generally, AEs as well.
Got it. So it sounds like is there a coordination between you're trying to use the emails to warm up the lead and then the call? Yeah. Okay. So there is an element of coordinating those two there. Got it. What is just high level? We don't have to go too far into it, but what does the sales process look like? So do you have SDRs making cold calls and then AEs running demos? What does it look like after from the cold call forward?
So we have a few different XDR segments. So we've got inbound SDRs that are following up on demo requests. We have PLG BDRs who are following up on PLG leads that have lower intent but some problem awareness. And then we have outbound BDRs who are largely, they used to do a lot of cold. Now we've been so successful on the demand gen side that they can actually go harvest. The BDR team spends most of their time harvesting prior demand. We're tilting them back towards cold right now because I think we oriented too far to harvesting existing demand, probably hit those leads too frequently because we've seen a decline in some of those win rates. And so now it actually makes more sense to tilt back to cold because we've gotten so much better at it with the craft investments and sort of the data preparation. And then they'll hand those opportunities off to a bunch of segments of AEs, inbound AEs, outbound single loc AEs, multi-location AEs. And then it's usually like a 1 or 2 call close, lots of OCCs, 1 call closes, and we'll do some chasing from there. But the sales cycles with 10 to 20 location customers will be a little bit longer, but for the most part, we're like ripping through ops.
Sounds very, very similar to single platform. It sounds like you said, not much has changed in regards to how to get through to a restaurant owner. The hard part's getting them on the phone, and then you move fast for the most part, right? You get straight to the point and try to get it done quickly. Yeah,
a lot has not changed, and a lot has changed. Like I know a bunch of people from the single platform mafia. That place produced a bunch of really great sellers.
Yeah, it really did.
Some of them are on my team today too. Our 2 like OG sales guys were both single platform dudes.
Who are they?
Tom Carmody and Chris Morera.
Okay.
A lot has not changed. Restaurant owners are still really difficult to get on the phone, and the level of technology sophistication is low overall. They know how to get on a Google Meets now because of COVID. They much
That's
like everybody.
What I thought changed some things. Is it sort of leveled everyone up with that? And the internet's just better now. I mean, 2012, we would have bandwidth issues. Like they would have to restart their modem. Like there was a lot of that. Yeah.
It's not perfect, that's for sure. There's a lot of like trying to teach somebody to get on a Google Meet. That's why we don't use Zoom. We were on Zoom and I pulled us off just because it was it was even more complex. And what has changed probably the most is the level of experience people have with technology more generally. And there's a pretty like long history of people now feeling distrustful of technology companies.
Yeah.
Like Yelp comes up all the time. People really like have a bad taste in their mouth from the Yelp sales experience and getting locked into contracts and feeling like, there's just that's one of the companies that comes up all the time. There's a bunch of point of sale companies that get mentioned. There's a bunch of our direct competitors that have horrendous Better Business Bureau pages because they're, like not very trustworthy or like upstanding people to do business with. And so there's a lot of that pressure for sure that we feel. And so we have been smart about reacting to it. My selling style has a particular advantage in this market. So I teach a radically transparent style of selling where we lead with both the things that are good about owner and the things that are not good about owner to let people, let the buyer opt in or out of the buying journey really early. We don't lock people into long-term contracts. When people cancel, we actually make it pretty easy for them. Could we put more friction and nudge our retention rates up? 100%. We could do what the newspaper companies do and like make it horrendous to cancel. But I don't believe in doing business that way. And I think especially selling to restaurants who are a distrustful bunch because they haven't been treated all that well, this approach has really worked for us. And there's a bunch of companies that like hold their domains, hold the customer's domains hostage and will lie and like threaten to them. There's a big like pizza SaaS platform that I won't name that, just like pulls every underhanded trick in the book. And that leads to us losing out on some deals because they're scaring that customer. Yeah. But I believe long term that that is just like a short term view of building business and will eventually be a reason that we win and they lose, because we're not only the highest rated company in our category, we're the single highest rated software in all of restaurant technology. If you look at G2 or Trustpilot, like there's not a single restaurant tech company that has better ratings and reviews than we have, because our happy customers who do really well, they crush. And they do really awesome. And sometimes customers don't work out. Like no product is perfect, but in those scenarios, we treat them in a way that makes it so that they're not running to G2 to just like rip on us and tell all their friends how crappy we were, like many of our competitors. So we're playing a long game. I've sold like this for a while. And as I learn more about the restaurant market, I've even leaned harder into this approach, even though it is challenging short term. I'm a big believer that it's a long-term advantage.
Everything you said, totally aligned. I mean, it's just given me flashbacks to all the stuff that we dealt with back then. I had a couple questions, but I wanted to touch on a few pieces here. One thing that I noticed that changed in selling to restaurants is when everyone started using smartphones. That's what I think was like the turning point of they started to understand technology a bit more. Because I was thinking back to like, you're talking about Zoom and Google Meets and whatnot. When we were first selling to them, one of the things we were selling was mobile websites. And we would just try to explain to them the importance of mobile optimization. It was hard to even explain because most of them didn't even have their own smartphones and stuff. So I think that's probably where you're saying like there's this technological change. I think it's them going through COVID, the Zoom piece, all that makes sense. How are you guys, I wanted to ask this real quick. How are you guys handling territories? Do you split people up based on location or no? Do you have another way of distributing leads? Because we did not do location at single platform. Everything was just, we distributed leads basically. We assigned them and you could be calling anywhere in the country basically.
We are pure round robin. Territory model. So you can go one of two directions, and both work. There's actually no right answer, but your strategy needs to be congruent throughout. We have taken this strategy. We are all in on digital. We don't do any site visits, or we don't like do any in-person demos. We don't knock on doors. We don't geo target our sales team. So we might have a rep in Denver and the demo gets in a meeting with a Denver restaurant, and the meeting might be run by a guy in Dallas. That's entirely possible, and that would be a suboptimal decision at the micro scale. But at the same time, to re-architect the whole system to prioritize geo while also maintaining some fairness in terms of the rotator and optimizing for the distance between meeting booked and held date. Mm-hmm. It just doesn't make a lot of sense for us. when you look at what drives meeting show rates, which, as you know, in restaurants is a big thing. You get a lot
What
of
is yours?
no-shows.
Ours was about 50%. That's what we aimed for.
Depends on the channel, but it's up to like 75, 80% for inbound and
Wow.
70-ish% for outbound. But like we run a crazy tight meeting show playbook.
Yeah.
We send them what we call a sell between with pre-call or with PCR, with pre-call research. We call and text them the day of the demo. We call them like as the demo's starting. Hey, just calling to make sure if you just calling to see if you need help getting on. Like
And they've got the iPhone now, right? So if you can get that, are you guys trying to get the cell phone number so you can,
we only call cell phone numbers.
Got it. So that's a huge difference. When we would have to call for the demo, we were calling back to the restaurant most of the time.
Nightmare. That's a nightmare.
Yeah, I mean, that alone gave us immediately, we could never get up to 70 or 80%, stick rates on that. I would always try to get their cell phone number, but most people, if they had cell phones back then in the restaurant, like maybe it was a BlackBerry, but probably it was a flip phone, like just people weren't really, not everyone had a smartphone yet. So they didn't have their calendar and everything like, in their hand. So that sounds like it's game changer for you guys. That's awesome.
Yeah. Yeah. And so this model works for us. Toast basically is the opposite model, and it works really well for them. You can listen to Jonathan Vassal's talk on, I don't know if it's 20VC or the science of scaling, but he talks about their regional strategy. They have reps in market that own a territory. They're connected with their partner reps in the territory. There's CS people in the territory, and that works. Like ours.
Do they go on site a lot? Is that why they're doing that?
Tons.
Yeah.
Tons.
Yeah. Okay.
And so both strategies work. And I think why they have a really well-run go-to-market org and why I believe we do is that things are congruent. So we've said we are going to take a digital approach. So even if we would like to sort of tweak at the margins and rotate ops to a person that lives close, we've just said, hey, we know it's an opportunity cost and we're okay with it. We're all in on this like more digital go-to-market because of the scale that it provides. It provides the opportunity to do many things that you can't do in market. I think where you get into a lot of trouble is trying to do both.
Yeah.
And there are other competitors of ours that are in this like no man's land where, they have a local market, but they're also running a bunch of meetings digitally and they don't have in-market support. So like there's an AE in market, but no CS people there. So like you really have to pick one or the other in my opinion. And this is true of like many different types of business where you really have to be clear about like, what are the decisions I'm making and how do all of my decisions stay connected and congruent so that you're not getting stuck in sort of the middle layer.
Yeah.
You mentioned this before we hopped on, but like, you have some opinions about, growth at all costs and why it doesn't make sense anymore. And, companies should be more profitable.
In certain cases.
Yeah. Yeah. And we're playing a much more aggressive growth game, a traditional, like raise a bunch of money, go win the market. And both are actually true. I think, you have to know what game you're playing, and then things have to be connected. If you're going to raise a bunch of venture dollars, you better spend fast. You better try to build a platform and not a point solution. But where people get trapped in this is they raise venture dollars with venture expectations, and then they try to play an efficiency game, and they're wondering why their board's not happy.
Yeah.
Or you're playing a bootstrapped game, but spending like you're a venture-backed company. Like those are both dead ends, in my opinion.
Yeah. Yeah. Well, you hit the nail on the head on so many things there. The one thing that it sounds like we agree on everything so far, but you talked about sort of picking a lane, right? Like, are we going to be doing, and I think what you meant there, I want to just clarify, you guys mostly doing inside sales. You're not going out in the field.
Yeah.
That's what you meant by saying you're digital first, right?
Even if the restaurant's like, hey, can you come by and do a demo in person? We don't do it.
Okay, so you're strictly not doing it. Okay, so this aligns so much with my early experience. I mean, I saw single platform go through that because they started out with outside salespeople, which maybe made sense in the very, very, very early days because they were going around to New York City, and it's how the CEO started selling it. Like he knew all these restaurant owners because he used
Yeah.
to work for Seamless and all this stuff, and so. But they faded that out. Like they quickly realized that the way to scale this thing was to have everyone under one roof, everyone following the same process. And, then I went to doctor.com where we were selling a similar product, but into small practices, healthcare practices. And we had the same kind of thing going on. I had some people outside, some people inside, some people going to trade shows. And it didn't take long to realize, like, if we just keep diversifying our efforts, like, it's hard to get great at one thing, right? Because you have to have an infrastructure and a process for everything. And outside sales, I found, it doesn't mean it can't work. It certainly can, but it requires a lot of dedicated resources. And when you try to sort of overlap them, it's like they're always kind of pulling away from what's going on inside the office. So I'm completely with you on that. But you brought up
Congruence. Congruence
yeah.
is the key.
And simplicity, right? Like when you can just focus on doing one thing, I think you're most likely going to end up doing it better. Whereas when you have these different things, I mean, even with the territories, that's the reason that I never gave people location-based territories, with the exception of Aircall, where we were global, right? You would have an element of that across teams. But for the most part, like I always wanted every single rep to have the exact equal resources. I wanted them to have, randomly distributed leads that were, in some way weighted, equally, whether it's round robin or whatever. I wanted them to have the same training, the same amount of maybe inbound distribute. Like as much as I could make everything even, I wanted to, because it just chipped away at all the excuses. And I know that excuses are like, it's that thing in the back of a salesperson's head that gets in the way all day long, right? So the more of those that I can just make obsolete, I always found that just made everything so much easier. So, but you mentioned growth at all costs. I want to get your thoughts there. And, my thoughts on this one, it's kind of evolved a bit. I think, we talked a little bit before we started on this. I think that there are a lot of scenarios where growth at all costs has been abused. I think what we watched in the sort of ZERP era is just money just flowing into companies. Largely, a large amount of them weren't really ready for it. Products maybe not ready at all. And, maybe they had some product market fit or some initial traction, and then they raise all this money. And it just becomes basically like a pig with lipstick. Like, let's act like this is a unicorn, even though like it's nowhere near ready to even be called that. But we're going to apply the hiring tactics, the quotas, the growth projections, and all of those things that usually should be aligned with a company like owner.com, right? Like I look at what you're doing, I say, this all makes sense. Like raise tons of money, go crazy. Yeah. Grow as fast as you can, get the market share, like everything is working. So just go full steam ahead. But it seems like everyone just tries to do that regardless of when everything's working or not. So just want to get your thoughts there. I imagine you've experienced a bit of both through your career, and now you're in one of those sort of true unicorn scenarios where things are just working. And I use you guys and Rippling as examples of like areas where it seems from the outside, at least from where I'm standing, seems to make sense to go that aggressive. But then, when you see things like that happening and people are signing up for products and they're churning out 6 months later, and it's like, it's just this leaky bucket effect, and there's a big nightmare there. But wherever you want to go on that topic, curious to get your thoughts.
Yeah, a bunch of thoughts. And thank you for putting us in the same category as Rippling. We're not quite there yet, but I'm flattered because
I think it seems like you're on the way, if not already. I mean, when the product just makes sense and all momentum is just going in a positive direction, like that's where business logic is like pour fuel on the fire, right?
Yeah.
But so many companies are trying to pretend to be that.
Yeah. And so let's just take a step back, because I'm always shocked by the sort of the lack of understanding that many people in technology have about the water we swim in. And so I can't remember whose podcast this was, but I was talking about why I believe that revenue leaders need to spend a lot more time learning about venture capital than they do, because this is the ecosystem around you. Like, whether or not you know it, the venture dollars you take or don't take, the funding strategy, the portfolio construction of your VC determines a lot. And if you're completely oblivious to how venture capital works, you're operating with a big blind spot. So number one, go listen to 20 VC, go listen to BG2, go listen to, I was going to say All In, but they don't actually, they barely talk about venture anymore.
It's turned into a political podcast, right?
Yeah, go listen to a bunch of the venture podcasts out there. Actually, Jack Altman, who's a board member, just started a podcast called Uncapped. Go listen to his episode with Josh Koppelman. It's one of the best overviews of like the state of the market and why things are the way they are. Okay.
Is it safe to say, I just wanted to harp on that for a second, because I've said this in different words, but I think you just made it more concisely. But sort of what I've been saying to people is like, because I realized this, by the way, like 10 years into my career, and I wish I realized it in the beginning. I would have made different decisions. I would have understood certain things more, because part of my confusion in the beginning was like, I don't really understand what's going on with these businesses. They're spending money like it grows on trees. We're not making money. Single Platform was acquired for $100 million. It was doing less than $1 million in revenue. None of this made sense to me. Like my father worked his whole career on Wall Street. We would talk about this stuff. He couldn't figure it out. No one knew what was going on, and took a while to sort of wrap my head around, okay, these are just not like regular businesses. This is like an investment vessel where people are strategically trying to increase the valuation of their equity. And that's sort of the priority. And like everything else sort of often is like secondary. And it takes a lot to sort of wrap your head around that. And then you start to see like, oh, so that's why they're doing this. That's why, because this is really sort of the objective. And so anyway, I just wanted to throw that in, because it's such a sort of epiphany moment that people need to have.
So everybody should go read The Power Law. So it's a book by Sebastian Malby. It's about a lot of the history of venture capital and also explains how venture capital works. And it's called The Power Law because the Power Law defines everything in VC. The Power Law is basically the best performing assets in a class, or the best performing companies out of a portfolio, will generate almost all of the venture returns. So if you're a VC and you invest in 50 companies in a fund across 3 years, and let's just say you're a seed investor, so very early stage, half of those companies are basically going to go to zero, or they get acqui-hired and you're losing money on it, and that's fine. That's part of the math. And a bunch of those will get bought for 1 or 2x the return, but that doesn't really do anything because your money is locked up for 7 to 10 years. And now that's getting extended to 12 and 15 years because companies are staying private for longer. And so to have a good rate of return, to have good return on that capital, if it's locked up and illiquid, unlike buying a public stock where you could sell it anytime you need that cash in hand, if money is locked up for 10 or 15 years, it needs to return a massive amount of money to make that sort of profile of asset make any sense at all. And so in a venture fund, you're really looking for like a 3, 4, 5x return on the fund. So I put in $100 million and you want that to be $400 million by the end. To return a fund, so say you're lucky enough to own 50 as a seed investor, call it 10% because you're going to get diluted. Say you're lucky enough to have 10% of a company by the time it IPOs. For that to return a meaningful amount to a $100 million fund, call it, this would be a small fund, but for it to return a $100 million fund, that company needs to be worth $5 billion because you only own 10%. You maybe had 20% initially. You get diluted all the way down as you raise money, and then that is going to basically pay back the entire fund. And once you start to understand the dynamics of fund, like the fund math, nothing really matters to a VC other than those big winners. If you do a round at let's talk Series A now. If you do a round at like a $50 million valuation, because Series A's are getting much bigger these days. If you do like a $50 million valued Series A, that deal has to just like compound so much to return a meaningful amount of the fund. And so once you understand that, the other side of this dynamic is if you invest at 50 and they get sold for 150 and you own 10% of it, well, you're only really returning like a small fraction. So you're returning $15 million of a $100 million fund, for example. And like, that doesn't really make sense. And VCs make all their money on carry. You get 20%. So basically, once you've returned the entire fund, so you've given the $100 million back to all of your LPs, the people that put money into the fund, the institutional investors, then you get 20% of every dollar above that. So where VCs make all of their money is on carry. This is in the Series A. This is in Series A. The math's a little bit different with like later stage growth rounds. So this is why VCs only care about their biggest returners. They only care about the companies in their portfolio that potentially could return 10, 20, 50x, because 95% of the value in that fund comes from like literally one or maybe two companies. Yep. If you were in Uber, if you were in OpenAI, if you were in Instacart, if you were in like these like meaningful outcomes, nothing else matters. And so once you start understanding that about as a CRO, you're like, okay, that's why they want me to like sort of spend crazy, because the only thing that matters is the big outcome. So you want to just swing big, go for the power law return, or like just go to nothing. It doesn't matter, because the 2x return of playing a more conservative game, like it's irrelevant to them. And so you got to read power law. And the other piece, so once you understand that, going back to your original question and understanding the game you're playing, once you understand that, then you can make like better and better decisions about how you want to approach your day to day. And if you're in that business and if you're backed by like a marquee fund, it's like, yeah, you're going to be going for it. And maybe you ramp back on spend and growth while you fix product or fix churn, but you're always going to have to get back to a more aggressive growth trajectory. Or maybe you do like a one and done. I'm going to raise one round and then we're going to stretch that all the way. You got to know the game you're playing to be able to do your job the right way.
Bingo. Completely agree with you, and wish I knew all of this, earlier in my career. It just would have provided so much more perspective, because I think it's not that I chose the wrong places to work. I actually think that I chose mostly the right places to work. But it took a while to wrap my head around the why behind a lot of decisions, right? Because I was just saying, like, we're just wasting money here. We're doing things that don't make sense. Like, why don't we slow down, figure some things out? And then we can move 1,000 times faster once we get there. But it seems like we're trying to move so fast sometimes and just, break things, and seems so illogical. But like, once I wrapped my head around everything that you just explained, which is like these VCs, they want to put money into, 20 companies, and they're going to push all of you to take the actions that it takes to become a unicorn, because they just need it to work out for the one or two, right?
And unicorn is like the minimum
now that's
baseline.
like baseline. Yeah.
It's not even the way that these funds are constructed. It doesn't really even like unicorn.
That's probably the wrong word to use now. Yeah.
But so the other thing that's important here is understanding the fundraising cycle. And so once you understand how venture capital works, now you can start to understand how you're going to actually raise money. So VCs only want power law outcomes. So that means by the time you go to ask for more money, you need to be able to show that you could be one of those returners. Unless you're getting off the VC escalator and going down a completely different path, different capital sources, or you're fully bootstrapping from there, it's very viable, but you need to make that decision at some point. Because what you cannot do is have okay growth. You can't get caught in the middle zone. You can't have okay growth, but still burning a meaningful amount of capital and then try to go raise money, because you're not going to like the offers that come back. And then you get stuck under a liquidation preference, which is just like a bunch of terms in the deal that make it worse for your common shareholders or the equity shareholders, like the founders, because the terms can be like, okay, we'll invest, but we want a 2x 2x liquidation preference. So we get 2x our money before anybody else gets money. A bunch of this stuff starts to creep in when you've got mediocre growth. Oh, it's like, oh, we're growing 60% a year and we're only burning, $500,000 a month. Like, nobody wants to invest in a 60% growth company if you're only at 4 million ARR. Like, nobody can project out for that to be good fund math. And so now you can start to understand like why founders will act in the ways that they do. And we need to be able to act in this same way, in this congruent way. So revenue leaders are like, well, like, we should slow down, we should do that. You might not have the time. If you have 18 months of cash left, and you're saying, well, let's like slow down for 6 months and rejig some stuff, and then we can reaccelerate. Well, now you're starting to talk about starting your reaccelerating growth at month 9.
Yeah.
So maybe you post 3 or 4 months of growth. Now you might want to be able to raise money. Now you're trying to raise money with 4 months of cash left in the bank. No, you're going to get brutal terms. That's going to be a bad fundraise cycle. Like, we have typically raised money with almost 24 months of cash left in the bank. We've been preempted most times, but we're always trying to raise from a position of strength. And so you got to understand that as a revenue leader. And if you're listening to this and you're like, you are speaking Greek, like, I have no idea what you're saying, Kyle, you should go start getting studied and just like use ChatGPT and just be like, hey, I'm a revenue leader. I work in this type of business. Like, explain venture capital to me and what I need to know about the market. Go read Power Law, but get educated.
Yeah, and I'd argue even salespeople, at the maybe not SDR level, because you're probably focused on just learning the job and stuff. But once you're an AE and you've kind of got things figured out, start to learn this stuff, because it just gives you so much perspective. And this ties into what I want to talk about next. The next 2 topics are, what do you think is the reason for low VP sales average tenure? And then what do you think is the reason for low sales quota attainment? But I want to kind of tie this into what we talked about earlier, which was the importance of knowing how to pick the right employer. Because I think that also ties into everything we just discussed, which is like why you need to understand this stuff. Because it can be, number one, you might just, get tricked and pick an employer that raised a bunch of money, but the product's crap, and you kind of figure that out once you get in there. But you might also pick a company that just, maybe the product's great, but they've got, maybe their valuation's too high and they're going to be in a tight situation, or they got screwed through the pandemic. And there's all these sort of, nuances to look at. But let's talk first on the VP sales piece. Like, average tenure is about 18 months, and maybe even lower depending on who you ask or where you look. My thought is that that's too low. I do think it should be longer. I do think that we got into this weird thing of thinking.
But why? Why is it too low? Like, why does a VP of sales deserve more than 18 months? Like, I hear this kicked around all the time. It's just business.
I'll tell you my thought, and then I don't want to make this too much about me. I want to get your thoughts. But my take on it is, and look, this varies. It's different everywhere, right? But generally what I see happen a lot, and it ties into everything we just talked about with the venture capital fundraising, is that sort of what's always like top of mind for the investors, the founders, is they're always thinking about raising that next round of capital, and sort of always sort of managing like what the narrative is, right? And so if sales just didn't go well last year and you missed a target, they need to have some sort of compelling narrative on how that's going to get better. And I tend to think that just often becomes like, we need a new sales leader, but that's not always the reason that the revenue targets were missed. I would argue in more cases, it's that the product maybe just wasn't that great, or it's that the revenue targets just were set to be those unicorn T2, D3 numbers, and you're just not really there. Because it ties into everything you just explained, which is like they have all of these companies and they want to push them all to be, the best, but they know only really 1 or 2 are going to get there. But what happens to the rest along the way is that they have to keep sort of making up excuses and narratives, and just kind of keep rebuilding the sort of the storyline. And I think sales leaders become victims of that a lot. It doesn't mean that they're not, right. Maybe sometimes it totally is their fault. But I think that tends to happen. It's sort of a bit of a blame game. And then there's one other thing that I think plays a role into it, which is it's sort of overlaps with it, but it's this notion that like you need to have someone who has experience at a certain stage. I do think there's value to that. But I also think that if you look, there's any of these people did that for a first time somewhere. And oftentimes the first time they did it was their best time. And so then you hire them because they have experience, and then they tend to, it doesn't even go as well the second time. So that's what I see. So I do think that there's just a lot of sort of assumptions there that get made, and it's not always the VP sales fault. It doesn't mean that like VP sales shouldn't get fired if they suck. Like, of course they should. And it's probably going to be a high turnover role either way. But I've seen a lot of instances in my career where it was just like, not just me specifically, but friends and whatnot, where it just looks like they're taking the blame for something that was so far out of their control. But wherever you want to go on that, curious to get your thoughts.
I think there's just as much blame on VPs of sales as there is on founders. And because I see this from both angles, like from the work in GTM Fund and my advisory portfolio, I work with founders trying to help them find VPs of sales, pick the right one, help them get scaled up. And I think there's a few things that VPs of sales do that sets them up for this short tenure. One, everybody's pushing for the goddamn title. Like, you're not a VP of sales yet. You've been a first line manager at a pretty good company, and now you go around the market expecting to be a VP of sales. And I see a lot of people like push to secure that title.
Yeah.
Well, the expectation you're straddling yourself with now is way different than oftentimes the like capability of that individual. And I think they set themselves up for failure. And I see this, this is one of the most common pieces of advice I give. It's like, don't optimize for title. In fact, take a director title. Like if it's a good company, take a director title, work your way into a VP title, just because the expectations will be like more in line with where you're actually at in your career. I see a lot of people take, they're a good first line manager. They could go be, or say you're a good second line manager at a mediocre company. You could go be a second line manager at a way better company and learn a bunch of lessons and actually have equity that is meaningful. And what you find is people go to an even crappier company because they can get a VP of sales title or sometimes like a CRO title, but like that company was never going to be successful no matter what you did anyways. But you still took that job.
Yeah.
Like, I think the VPs of sales, like, oh, I got blamed for a bad product. Well, you chose a company with a bad product.
Yeah.
Like I'm a big extreme accountability person, and I look at those scenarios and people are like, oh, I got blamed because the product wasn't good and the CEO needed somebody to like scapegoat. It's like, well, you took a role with a crappy company. So like, what did you expect? You did no diligence. You didn't talk to any customers. You didn't talk to reps. You didn't talk to people who left the company. You didn't ask to look at the financials of the business. You didn't sit down with the CFO and go through the unit economics and the win rates and the retention rates. Because if you did, you would have known not to take that role, or maybe you would have still taken it because you want a VP sales title on your resume. I think even in the scenarios where growth was stalled because of bad product, I still don't really blame the founder outright. I think there's just as much on both sides, because like you took that role, and we chase these shiny objects. And I started getting CRO offers after 2019. No. Yeah, 2019. I got my first CRO offer. I declined a CRO offer at the time, a pretty good Series A company. It was like pretty good, but not amazing, because I was, a first-time VP of sales, had a good, okay track record, but couldn't get anything marquee at that point. And I turned it down, and I took a senior lead title at Shopify. I optimized for company quality, for working with really smart people on a good mission. And Shopify sort of hilariously depresses titles. And so I was a senior lead with like an 80-person org.
That's common at big corporations like that, right?
Yeah, I mean, even senior, like it's even more so at Shop. But and then I took a job at Owner with so I had gotten my first CRO offer 3 years before, and I took this job at Owner at an SVP sales title. because, founders are reticent to give away a C-suite title, especially to revenue leaders. And it's like, fine, like I'm fine with it. I'll earn my way into it. No big deal. Even though this was basically the only company that I had a conversation with that wasn't a CRO title, because I was optimizing for company quality. And you just don't see that much. People like want the title and they prioritize it over company quality.
Yeah.
And those things are inversely correlated, which is the weird thing. The company that will give you the best title is probably the worst company for you to join, because they don't have the negotiating leverage in the market or the candidate pool quality to like leverage you into taking a lower title. Like the best company owner like had the most trajectory, most like excitement, best metrics, and therefore I'm like, whatever, like I could squabble about the CRO title, but like at the end of the day, I was happy with the pay, I was happy with the equity, I was happy with the scope, and sure enough, like it evolved into this. But I just like I don't see people make good decisions.
I want to double click on something you said there. When it comes to doing that due diligence, right? You're a few rounds into the interview, or you're at the negotiation phase or whatnot. You're sort of in there. It's not finalized. You're thinking about it. Is it you mentioned the one specific thing that stood out to me, which is, ask them for the financials. And because all the other things I think you can always do. You can reach out to customers, employees, like these things are pretty much within your control. I've been in situations where, and I want to get your thoughts, is for me, major red flag, I'm walking out the door before we even get in the door if you won't share the financials with me. I'll sign an NDA, whatever you need. But if there's a weird hesitation to open up those books, I find that is a very bad sign. Do you agree?
Absolutely.
Yeah. Okay.
Yeah. Terrible sign. And
I mean, before you've taken the job, right?
Yeah. Before you've taken the job.
Yeah.
The better way to ask is to have the CFO or head of finance get on a screen share with you. Be like, look, I know it's really sensitive to send somebody financials. I'm not asking for that. But I would love to get on an hour-long call with the CFO and just have them walk me through the growth model, the recent financials, the last board deck, and go through it and ask a bunch of questions and stress test conversion rates, unit economics, burn, retention rates. I've got like a half-written newsletter post, which I think I'll do it on my flight. I do like a bunch of my longer posts on flights because it's the only time I have quiet. I'll do a post on how to do the diligence and validation because it's an important topic. Yeah, and if they won't even screen share stuff, there's probably a bunch of that is a major red flag, and I just wouldn't take that role.
Yeah. When I went to Aircall, I really appreciated the sort of like there were some cultural differences, this French founded company. And one thing that he did is like, after I like agreed I wanted the job, we agreed on terms and all that stuff. He goes, I want you to come in one last time. I won't try his French accent, but it was in a French accent. And I want you to come in one last time. And it wasn't to interview me. It was to tell me all the dirt, all the bad stuff. And to see if I was still excited after that conversation. And I was so grateful for that level of just radical transparency that he was like, look, we talked about all the good and exciting stuff, and that's what our whole recruitment process has been like. But just before you sign on this dotted line, like, let me tell you the problems that we're dealing with, right? And let me double click on some of those, so to speak. And I thought that was so important. And it was a stark difference from something else that I observed, which was a situation where there was a new CRO and a new CFO who both got hired at the same time. And within the first 2 weeks on the job, neither of them could get access to the financials. Now think about that. The CRO and the CFO can't even get access. And it's like, that was a disaster. It completely blew up, and neither of those people stuck around. And so totally with you there.
Do the diligence.
Yeah.
Don't take the job without the diligence. Go take another job, even though you want the VP sales title, even though it's good money. Like, go people should just optimize for company quality. Just go to the best company possible and take whatever job you can get there. Your career returns will be so much greater because you can skip through a bunch of these crappy VP sales roles. And then as soon as you rip through 2 or 3 of them, people go, okay, so there's something wrong with this person because they can't stick, even if it's not your fault.
Yeah.
It was your fault because you're a bad picker. But like you could be good at the job and just be a bad picker, but then people don't know that, and you back yourself into a corner. If you go to an awesome company and you're good, maybe you're not going to get to the VP title as quickly, but at the same time, you could be a second line leader across, a $40 million ARR target and have, a 60-person team, and you're not the VP of sales, but you would have been the VP of sales managing 6 reps directly with like a $1 million ARR target. Like it's superficial.
All right, so let's do rapid fire. There's 2 more. The last one is just what you're hiring for, but what's your take on AI in sales over the next 5 to 10 years? Do you have a high level take there? Are salespeople being replaced, or are these tools that we just need to learn how to use?
Both. AI is going to replace a lot of roles. I think people will go into different roles and probably with higher leverage. We are also massively focused on augmenting our team with AI. I just posted on my LinkedIn an hour-long keynote that I did with Jason Lemkin at SaaStr, where this is the entire topic. So if you want an hour of me,
perfect.
I also just wrote an article on my Substack, which is like a memo I wrote to my team about the urgency that I need to see in terms of AI adoption. So I'm talking and podcasting a lot about this. I just had Mike Donahue from 11X and we talked about AI and go-to-market. So just go to my Substack. There's a whack load of stuff.
Perfect. What roles are you hiring for? Anything you want to shout out? Who should apply? Who are you looking for?
Everything. We're hiring BDRs and SDRs in Toronto specifically. We've got a sales hub there. We're hiring account executives remotely. And I'm hiring for a GTM AI lead, someone to basically lead our AI strategy within go-to-market, hiring a head of Salesforce architecture, manager, sales and BDR managers. So
you are looking for a BDR manager. I actually got a buddy who's looking, so I'll let him know.
Okay. If he's world-class, I want to meet him.
Yeah.
Everything.
Awesome. Well, thanks so much, man. I'll let you jump. Sorry, I didn't realize we ran a bit over here, but
yeah, it was good.
Yeah, it's been good. We'll have to catch up again sometime.
Yeah, thanks for the time, Collin.
Thank you. Bye-bye.